There is a persistent belief that owning a bank or a casino is the most reliable path to permanent wealth. On the surface, the business model seems to defy the usual risks of commerce. You either guard other people's money and lend it at a premium, or you build a floor of games where the mathematics of loss are literally written into the rules. However, the actual history of these institutions is defined by sudden, total evaporation. In 2008, Washington Mutual, the largest savings bank in the United States, collapsed in 10 days. In 2023, Silicon Valley Bank went from a stable 40-year-old killer of the tech world to a government takeover in just 44 hours. Even the most opulent gambling empires aren't immune. When the billion-dollar Taj Mahal opened in Atlantic City, it was marketed as a landmark of financial power. It filed for Chapter 11 bankruptcy exactly 1 year after its doors opened. Despite their different industries, banks and casinos are built on the same foundation. They are high fixed-cost logistical operations that rely on the constant flow of capital they do not own, and they both carry the same structural vulnerability. The first barrier to entry is proving to the government that you can be trusted with the public's money. For both banks and casinos, the regulatory process is a marathon of invasive scrutiny, requiring owners to prove their suitability through an exhaustive audit of their history and associates. Once licensed, the financial requirements are unyielding. To operate a bank, federal regulators mandate capital adequacy buffers. This is a massive pool of the owner's own cash that must sit idle to absorb potential losses, ensuring the institution doesn't fail the moment a few loans go bad. Casinos face an identical requirement, called the bankroll. It is a mandated reserve of liquid cash large enough to theoretically pay out every winning bet on the floor at the same time. If a high roller hits a hot streak and your reserve dips too low, regulators will shut you down instantly. Beyond these reserves, the daily cost of simply existing is staggering. You have to fund an army of compliance officers to navigate thousands of state and federal laws, maintain a high-density IT infrastructure, and operate a cybersecurity grant that runs 24 hours a day. There are also specific costs required to keep the environment stable. Banks must fund loan loss provisions to cover the inevitable percentage of people who won't pay them back. Casinos rely on the comp system, providing free suites and meals to ensure players stay at the machines for as long as possible. Before a single dollar of profit is realized, both businesses must feed a massive, non-negotiable daily overhead. They are machines that require millions of dollars in fuel just to keep the lights on. To pay for that overhead, both industries rely on a single fact: they do not sell their own money. They sell credit and entertainment fueled entirely by the deposits and bankrolls of their customers. A bank functions through fractional reserve banking. They take your deposit, keep a small fraction in the vault, and lend out the rest to the next borrower. The system operates on the calculated assumption that not everyone will ask for their money back at the same time. A casino uses the same logic of volume through time on device. Every design choice on the floor is engineered to maximize bets placed per hour. The more hands played, the more the institution can rely on the law of large numbers. This chart shows the narrow margin of a typical transaction. A bank's net interest margin, the spread between what it pays you and what it charges a borrower, is often only about 3%. A casino's house edge on blackjack is even smaller, between 0.5 and 2. It's a small amount of your own capital to control a massive amount of borrowed money, the customer's deposits or the bank's debt. During stable times, leverage magnifies your returns. A 1% profit on a massive pile of borrowed assets can turn into a 20% return on the owner's actual investment. This is why banks and casinos can generate profits that most retail businesses can't imagine. But leverage works with perfect mathematical symmetry. When your revenue drops even slightly, your fixed costs and borrowed liabilities stay exactly the same. Because your own capital cushion is so small compared to the money you owe, a small loss on your assets can instantly wipe out the entire value of the business. For a bank, the trigger is often a shift in interest rates from the Federal Reserve. If the cost of keeping depositors' money rises, while your income from long-term loans stays flat, your profit margin can evaporate overnight. This is the inescapable math of borrowed growth. Leverage ensures that while the good years are extraordinarily profitable, the bad years arrive with a speed that the institution's capital is rarely built to handle. Silicon Valley Bank failed because its assets lost value just as its depositors needed their cash. The moment customers realized the bank might not have their money, they withdrew $42 billion in a single day. The institution didn't die from a lack of math, it died from a lack of confidence. The Taj Mahal failed for the same reason. The interest on its massive debts was so high that it required a constant, uninterrupted flow of players to stay solvent. When that flow wasn't enough to cover the vigorish of its debt, the entire structure collapsed. In both models, the machine only works if the raw material, the deposits or the players, continues to flow in. Because both businesses operate on money they do not own, they are entirely dependent on the public's willingness to leave that money in the institution's hands. Owning the house means running a machine that turns human confidence into a revenue stream. The math is designed to be invincible, but it only functions if the flow of capital never stops. When the trust that powers that flow evaporates, the system doesn't just slow down, it ceases to exist.